Hello everyone and welcome back once again with the next topic, IAS 16 property plant equipment and IAS 38 intangible asset. Very important topics from exam perspective. Every examination you will have either question on PP or intangible asset or investment property. 5 to 10 marks question, 11 marks question, 15 marks question may be asked in the examination. What is the type of question they generally ask on these IAS 16 and 38? We will see quickly. Very typically, they will ask question on either of these 5 principles which we have done. 5 principles. When we are looking at the financial reporting, there are 5 main principles. Number 1, recognition. Recognition of an asset, liability, income and expenditure or equity. The same principles which are given in the conceptual framework and recognition criteria. It is the first principle of any accounting standard. When to recognize, the timing, date. Second, measurement. Once you have recognized that line item in the financial statements, at what amount it should be measured. So that is initial measurement and also the subsequent measurement as on the reporting date. Number 3, how do I present it? Whether it should be part of non-current, current, whether it should be part of revenue as far as income is concerned or other income. That is a presentation. In case of equity and liability, should I present it as equity or liability? Number 4 is your derecognition principle. So once it is recognized, asset and liability or equity, it may need to derecognize. So mainly asset and liability, when to derecognize, not about equity, because equity is derecognized only once the entity goes into the liquidation cost. There are other aspects also, we are not discussing that right now. So 4th principle is derecognition and 5th principle is the disclosure. Not entire information could be understood from the numbers. So you need certain disclosures with respect to those numbers. So those are the disclosure requirements. These are the 5 important principles over which a reporting standard will discuss about. We need to understand that, and on this, the questions in examinations will be asked. As far as PP, intangible asset and investment property is not written here, but we will also cover investment property to some extent. Specific aspects with respect to investment property will be dealt separately, but otherwise recognition, measurement, initial measurement, subsequent measurement will be discussed as a part of this topic itself. Because these are all non-monetary assets which we will deal parallelly. Most of the principles are aligned with each other. If there are different principles with respect to subsequent measurement, we will better understand it, and that's why we are doing it parallelly. In examinations, questions, if you see, there was recently in June 2021, there was a question on intangible assets for 11 marks. Before that, in December 2020, there was a question on property, plant and equipment for about 15 marks. So if you see these questions, we are going to deal with this December 2020 questions, not the June 11 one, June 21. However, if you see this and read these questions carefully, you will find that the question is on recognition. More than recognition, because if you decide the recognition, sometimes it becomes easier for you to measure that. Let's say, I'll give you one example. If the asset is imported asset and you have to utilize or use a foreign exchange rate in order to convert that foreign currency denominated property, plant and equipment into your functional currency, then which rate should be used? So date of recognition rate you have to use. So recognition principle is also important for you to understand. That is very simple one in examination generally. That's not difficult, but we'll see that. Second, measurement is absolutely important. Initial measurement. Subsequent measurement is absolutely important, and within that there will be componentization, subsequent expenditure, etc. will be there in the questions. So majority, recognition, initial measurement and subsequent measurement. On these three aspects you will find number crunching questions with respect to 16 and 38 and also sometimes 40. IAS 40 investment properties. With this in mind, we will start for this topic. This is a basic one, but I think which is the most important, because if you try and understand the structure of the reporting standard per se, if you understand it here, it becomes easier for subsequent understanding or understanding of the subsequent reporting standards. Okay, so let's start with property, plant, equipment and intangible assets. Very quickly about the definitions, we'll not spend much time about it. Whether this will be asked in the examination, may not be directly. However, you may get a scenario-based question in the examination. Scenario-based questions, some kind of a scenario situation will be provided to you, and you will have to answer that. So probably your senior or your junior is asking you some questions. You have to answer them. And if you have to answer them, you have to also give the justification. In justification, you might have to use this definition. And that's why we have to do this. Nobody is going to ask you the exact definition given in the accounting standard directly. It's very rare. So, but in scenario-based questions, in order to actually analyze the situation and checking whether it is property, plant and equipment or not, whether this is asset or not, whether it is intangible asset or not, then question comes about whether we should recognize it or not. First thing, whether it is asset, whether it is PPE or intangible asset. If yes, then come on to the recognition principle. But before that, you have to analyze it. Then how you will analyze it? You will analyze it with the help of this definition. So understand it. You don't have to produce it as it is. Absolutely not required. It is in your own words. It is not required. But it is not required to print this definition per se. However, the gist of that definition should be there, even if it's in your own language, but that gist, important pointers will be there. So I've not given the definition in one single sentence, none of it. I've given the pointers. So those pointers, if you try and remember, then and produce it in the examination as your answer, then probably it becomes easier for you to get the marks. Definition of asset. Very simple. Asset is a resource which is controlled by an entity from which future economic benefits are expected. Only 3 points. First of all, it needs to be resource. It doesn't require, it is not required that you should possess that. No, it should be within your control. What is control? You should be able to use it as per your own discretion. You should be able to allow somebody else to use it as per his discretion, or you should be able to restrict somebody else to use that. If you have that capability, then you have a control. Correct? So resource within your control. But for what? From which future economic benefits are expected. If there are no future economic benefits, how that resource is resource? So last point is absolutely important. Future economic benefits are expected to flow from the entity. Future economic benefits are expected to flow to the entity. Sorry. This is asset. Now, as a result of past events, of course, how will you get the control? So it must be out of the past event. That past event may be the purchase event, construction, or whatever it is. We will go to the next definition of property, plant and equipment. Property, plant and equipment are tangible assets. So they are saying tangible items. Tangible items, tangible assets. These are assets which are within your control. So in order to determine any tangible asset as your property, plant and equipment, it must satisfy point number 1 and point number 2. What are those? Number 1, that tangible items must be either used for production purposes or for supply of goods and services. Held for production. So that asset will help in the production or supply of the goods and services. That itself is not for sale. This is important. If that itself is for sale, that becomes inventory. So that will actually help us in manufacturing something or to supply something or for rental to others or for administrative purposes. If any of these three reasons or objectives suffice and it is expected to use for more than one period, then it becomes your property, plant and equipment. If it is less than one period, then there is no point in capitalizing that. Any which ways in 1 year itself, it is going to get used completely. And that's why it has to be for more than one period. One period, it is explained in the standard that generally 1 year. Okay. So you have to remember this. One point which is important here is tangible items being land and building. Being land and building which is held for rental purposes is considered as investment property. We will apply IAS 40 for that. We will not apply 16 for such land and building which is held for rentals. Any other tangible asset like plant and machinery, etc., cars, vehicles, other vehicles held for rental purposes will still be considered as PP, but land and building held for rentals will not be considered as PP. Those will be considered as investment property. This point is important. You have to remember this. Intangible asset. Intangible asset, there are only 2 points. This must be an identifiable non-monetary asset. Here the purposes are not given, unlike your tangible items. For tangible items, for which purposes they should be used? Either for manufacturing purposes of supply of goods and services, for rental purposes, or for administrative purposes. Such purpose is not given for the intangible assets. Intangible assets are identifiable, very important word. So whatever language you use, I mean your own words you use, but this must be there in your exam, in your answer. Identifiable. And you must explain what is identifiable if you are answering scenario based question. If you give these 3 pointers, that identifiable and the meaning of identifiable, then you will get the marks. Otherwise marks will not be given to you. Whatever language you use, if you have this identifiable as one word, non-monetary asset, and without physical substance as these 3 words, and the explanation of identifiable. What is explanation of identifiable? Either separable, or arised out of contractual rights. It must be arised either out of a contractual or other legal rights. So I have written contractual. You have to also write or other legal rights. Contractual or other legal rights. If it is arised out of that, so right, so that's my asset. What is identifiable? Identifiable either that resource. So we are talking about non-monetary asset. Asset is a resource. If that resource is arised out of a legal or a contractual right, then it becomes identifiable, because I cannot see that. So how do I prove the very existence of that? So it must be arised out of a legal or a contractual right, or it is separable. So I have control of that resource which can be separately sold or given on a finance lease. Correct? For lesser, there is still finance or operating. For being lessee, there is no finance or operating lease. So if I have that asset, that resource, which I can provide it either on finance lease, being a lesser, or I can sell it separately from that entity, then that becomes separable. Doesn't make any difference. Even if it is not separable, but it has been arised out of a legal or a contractual right, it becomes identifiable. Either of these two, and it's or. This is very much important. Or. Correct? Either of the condition is satisfied, either it is separable or it has been arised out of legal or contractual right, it becomes identifiable. Such identifiable non-monetary asset which cannot be expressed in terms of money or money's worth. It cannot be expressed in terms of money and money's worth. It becomes non-monetary asset. Correct? Then it doesn't have a physical substance. Physical substance? Physical substance in the sense any kind of a right. It could be contractual or legal right. It arises out of that contract, it may be written on a paper, or it may take some kind of a shape of a tangible asset. But the point is, which form has a more value? The tangible form has a more value, or intangible form has a more value, considering that you have to capitalize it as intangible asset or tangible asset. If the tangible asset is more valuable than intangible, then you will capitalize it under 16, not 38. But if intangible portion has more value than the tangible one, then you will capitalize it as a part of 38. So this is explanation I'm giving. You need not write this much thing in the examination. Write it very short and simple. What is identifiable? So give this 2 pointers. Whether first of all it is identifiable non-monetary asset. Provide that. What is the scenario-based question which is given? Provide. With the given facts, this resource is an identifiable non-monetary asset. For being identifiable, it either must be separable, or if it is not separable, then it must be arised out of a legal or a contractual right. So you identify that in the scenario given in the examination, and you analyze it. If it's separable, then you need not check whether it is contractual or a legal right. But if it is not separable, then check whether it is a contractual or legal right. Mention that and treat that as an intangible asset without a physical substance. If you write this, you will get that marks related to the definition and its analysis. Okay, simple definitions. Read it and try to write it down. As simple as that. There are a lot of practical past examination questions on intangible asset when you will get this opportunity to write this definition or analyze this definition and write it. Okay, so do that. Scope. It's very simple. Property, plant and equipment is applicable to all tangible assets except investment property, because there is a separate standard. IS2, it's a separate, even those are tangible items, but the nature and objective with respect to those tangible items is different from the property, plant and equipment. So there is a separate standard. Intangible items are not covered here. So there is a separate standard for the intangible items. So those are excluded. Intangible assets. There will be certain intangible assets where there is a separate standard like IS2 in case of software keys. Software key, let's say Microsoft Quick Heal or any other software company have keys with respect to their product, with respect to their software program. If you would like to use that, then what you will do, you will actually purchase that software key, enter it, and then activate it. It will be covered under IS2, not under 38. Leases, right of use asset, seems intangible or a contractual right. It's a contractual right, correct? It's arised out of a contractual right. However, there is a separate standard which deals with this, and that's why we will consider it under IFRS 16 and not 38. Deferred taxes, again the same thing. Financial asset, there is a very thin line between financial asset and the intangible asset. Intangible asset is non-monetary, financial asset is always monetary. And that's why you have to differentiate it between financial asset and the tangible items. Intangible assets, sorry. Exploration and evaluation assets, these are dealt under IFRS 6, not under this. And expenditure on development and extraction of minerals. So this development of natural resources, it seems it is an intangible asset, but specifically excluded here. But under IFRS 6 also there is no such provision to consider and capitalize this development expenditure. Under IFRS 6 also. There is exclusion. Here also there is an exclusion. So how do we do that? Then conceptual framework comes to our help. It says apply similar standard. So apply similar standard. So we will apply this. Correct? IS 8, not conceptual framework, I'm sorry. IS 8 says if there is a specific standard, apply that for accounting of it. IFRS 6 excludes that accounting treatment for the development expenditure. But then you have to consider IS 8, which says second in line, apply similar standard dealing with similar line items. So intangible items. So this principles of 38 will be applied here, but not directly per se. It has been specifically excluded. Okay. Now, initial recognition. We are coming on to our first principle, right? We are coming on to our first principle here. Recognition. When to recognize? So I have always told you the 2 pointers. Number one, probability of future economic benefits, and second is reliable measurement of cost. So this is probability of future economic benefits and reliable measurement of cost. So how do you explain this? In examination, generally if these are tangible items, cost, reliable measurement of cost is very straightforward and easy to understand. But as far as intangible assets are concerned, it is difficult for entities to estimate about the cost that can be measured reliably. As far as software development is concerned, it is again not very complex. But when it comes to the development of certain research formula into a product, then it becomes very difficult, because that development does not have a fixed timeline. And that's why cost incurred till date plus cost that will be incurred in future, determining that second portion is very difficult. And that's why second condition may not be passed. Even first condition may be difficult sometimes as far as development expenditure is concerned. Research expenditure, absolutely not possible to satisfy condition 1 and 2 both. Neither condition will be satisfied as far as research expenditure are concerned. Development expenditure, at least there are some additional criteria which are given which supports these 2 conditions. And then we will be able to capitalize the development expenditure. But generally, when assets are internally developed, forget about that development expenditure. Simple, like brand, for example. Brand will fetch you future economic benefits. That is for sure. First condition gets satisfied, but second condition doesn't get satisfied. Brand, you have internally developed it. Brand gets developed the moment and on the way, on a path, on a journey of your business. It's not, there is no particular time when you can say now my brand is established. Your brand is always in the process of getting established to a newer heights. And that's why costs which are associated in developing and building a brand, you cannot actually determine that reliably. And second condition fails. Customer list. You may have first condition satisfied, future economic benefits are there, but what expenses have gone for developing the customer list? There are a lot of students, participants keep asking that if I have a specific team which is there who is monitoring the expenditure, it doesn't happen that way. It never happens that practically. Theoretically, you can give so many examples like that. Practically, it doesn't happen like that. Your customer list gets developed automatically the way on a journey of getting or doing a business. And that's why costs which are incurred to develop this intangible assets internally, it is very difficult to have that relationship between the incurrence of cost and the establishment of an intangible asset. You cannot relate the expenditure to that building of a brand. Advertisement expenditure, you can't say that advertisement expenditure has built my brand to this extent. No, you can't do that. There is no direct relationship of your advertisement expenses with the intangible asset or the establishment of your brand. Okay, it might have developed to a certain extent. If there is a controversy with respect to that advertisement, your brand value may also decline. So you do not have a direct association per se of a cost and a brand. Okay, and that's why internally developed intangible assets, it's very difficult to pass the second criteria. Some assets like research some expenditure like research and development expenditure, these 2 conditions are very, very stringent and difficult to pass. At least development expenditure you can understand, but research expenditure you cannot capitalize. But for tangible fixed assets, but for property, plant and equipment, for investment property, this becomes easy. This is little straightforward as far as tangible fixed assets are concerned. It may be PPE, it may be investment property, where you receive the possession act of that asset. Generally I am saying that possession doesn't go with the control per se. I mean, even if you do not have possession, you can still have a control. But generally, practically, when you receive the physical delivery of that asset with you, there is a probability of future economic benefits. That's the association. That's given in the standard itself. And second, the amount which you have spent, which you will spend even further in future to install that asset, for example, will be the cost that can be measured reliably. These are generally straightforward to find out, and this criteria becomes easy for the tangible fixed assets. All right. So here, treatment about the research and development expenditure. If it's a research expenditure, always expensed out. You don't have to think anything about this. Immediately expense out. Development expenditure, if it satisfies the additional criteria, these are the additional criteria. These are 6 criteria which we have discussed in detail in a full-fledged, full-length batch. These are the 5 criteria. Number 1, 2, 3, 4, and 5. This support condition 1. Probability of future economic benefits. And the 6th one supports condition 2. Reliable measurement of costs. If these criteria are satisfied, then you can capitalize it the moment, from the point, the expenses which are incurred beyond and subsequent to the point of satisfying these conditions may get eligible for its capitalization. Otherwise, all expenses which are incurred before satisfying these conditions will be expensed out. Once these expensed out, these will not be able to recouped back for capitalization. Let's say for 6 months, I have expensed out certain expenditure. Now after 6 months, my all conditions are satisfied. I will not be able to capitalize the expenditure which are incurred in first 6 months. Those are expensed out. Only remaining expenditure which you will incur subsequent to satisfying of those conditions, those will be eligible to get capitalized. The disclosure is required for how much research and expenditure you have expensed out, which now you cannot recoup it. That is also an important expense disclosure required in the notes to accounts. Okay, so this is about the initial recognition. So you have to remember these criteria again for the scenario based question. All right, so scenario based question will be asked whether this is intangible asset or tangible asset or investment property. So you will analyze with the help of this definition. Subsequent to that, whether it can be recognized with the given facts and circumstances. There will be number of dates, couple of 3 days, 2 days, 3 days, out of which you will have to choose one date, and then you will have to decide from which date you will have to capitalize. Any expenditure with respect to internally developed research, asset, you have to decide whether you can capitalize or expense out. Explain about that. If once expensed out, you cannot recoup it back for capitalization. This is most important. You will have to give your answers. All right. So this is about recognition. Okay. In situation based or scenario based questions, it might be required for you to calculate the amounts for the capitalization. So you will do that with the help of this guidance. So explain with this help of this guidance, calculate also. Both things are sometimes required. In examination, you will see the answer will provide you marks will be awarded to both explanation and calculation. Alright. I hope you are with me till now. So most important aspect, the one aspect which we did about recognition. Now, calculation part about measurement, initial measurement, and then we'll discuss about the subsequent measurement. Initial measurement of property, plant, equipment, intangible assets, and I will write here investment properties. And for that matter, inventories also. 1, 2, 3, and 4. It is always at cost. It is always at cost. Then what does it mean by cost? That we have to see. It is not fair value. Remember this thing. The financial instrument, you will find that initial measurement of financial asset, financial liability or equity will be at fair value. That principle is not here. We are measuring these assets at cost. We are measuring these assets at cost initially. So what is cost? How do you determine cost for these four assets? PP, intangible assets, investment property and inventory. We are not specifically dealing with investment property and inventories in this topic per se, in this discussion. However, principles are same and it will be applicable to these assets as well. So even though inventory we are not taking it separately as a part of revision back, but still few principles we are going to cover. This cost, the expenditure that may go as a part of cost will depend on the mode of its acquisition. Which way that asset is getting into your business, that is very important in order to determine the cost. There could be 6 different ways by which we can actually avail or acquire that asset, out of which last 2, there is a separate standard we said we will deal with. So we will deal there in those specific standards. However, there are these 4 ways by which we will acquire the asset. Number 1, separate acquisition. Number 2, self-construction or internal development of the tangible or intangible asset. Number 3, asset exchange. Number 4, it is in business, acquired in a business combination. This could be the 4 ways. Otherwise, it could be gift from the government. We can call it as a government grant. Or lastly, it is acquired by way of release. But there are separate standard which talks about the initial measurement of such assets or the assets which are acquired by government grant or by way of leases, and that's why we will not deal with under IAS 16. Alright, so now we will see which expenditure can be capitalized, which cannot be capitalized. Lot of times you check the past examination question, lot of marks have been given here. And students do get marks. They have never lost any mark within this because this is such a simple principle, I will tell you. Simple to remember, easy to reproduce in the examination. You cannot go wrong here. And when I say that you cannot go wrong, you'll have to actually remember these things. And I'm sure that you will be able to remember this. Number 1, external acquisition or purchase. If I purchased it externally, then what all things can be capitalized, what could not be capitalized, that we will quickly see here. Number 1, purchase price. Of course, the purchase price along with the taxes which are non-refundable taxes or including import duties if it is being imported. Correct? Now the question arises when asset is imported and if it is denominated in the currency which is not the currency of the entity, it's denominated in foreign currency, then the rate of conversion, which rate should be used? The date when you recognize the asset in balance sheet, that is the date which you use, which entity should use to convert that foreign currency into functional currency. As simple as that. And you'll find these questions in the examination. Even if there is a separate standard on that, we must have knowledge here. Because combination of standards is very common in the examination. So purchase price plus all import duties and non-refundable taxes plus all directly attributable expenditure which are incurred. Now it's not written here, but I'll tell you. All directly attributable expenditure. What does mean by directly attributable expenditure? Those expenditure which are incurred to bring the asset to present condition and location in which management intends to use that asset. So directly attributable expenditure are those expenses, in the sense those are incurred only because that asset is there, or that asset is there because only those expenditure is been incurred. Simple. I will tell you once again. What is meant by directly attributable expenditure? You have to check it from both sides, okay? Directly attributable expenditure in the sense, if I incur that expenditure, then only that asset is going to be there. And vice versa also, that asset is there because I have incurred this expenditure. You have to check this, correct? That had I not incurred that expenditure asset, I would not have been able to use that asset in the way I would like to. Or that asset cannot be functional, or it cannot be used, or it is not usable if I do not incur this expenditure. If I do not incur this expenditure. Now you can analyze any type of expenditure, whether it is capitalizable or not. Let's say, for example, transportation expenditure. If I do not incur the transportation expenditure, I will not be able to bring that asset to the present condition and location. Installation expenditure. If I do not install it the way I would like to use it, I will not be able to use it. So installation expenditure is must. Site preparation, loading, unloading, all these expenditure are important. Insurance expenditure, must. Because unless and until you take the transit insurance, you may not be able to transport that asset. It's very important. Foreign currency translation fluctuations. Now, whether you incur fluctuation expenses or you don't incur fluctuation expenses doesn't make any difference. You pay that amount, the asset is there. Whether it will have any impact on the functionality of the asset, the answer is no. It is external part, whether you incur fluctuation or not. This doesn't go with the transportation. If you do not transport, you do not incur that expenditure, asset will not be at the location or at the site. But if you are incurring the foreign exchange fluctuation, it may be gained, it may be lost, doesn't make any difference. The asset will be functional. So that will not have barring. So foreign currency fluctuations will not be adjusted as a part of the cost. Training expenditure, very common. You'll find this type of questions in the examination. That entity has sent their staff for the training on that machinery. Machine can be used. Machine is ready for its intended use. You don't know how to use it. It doesn't mean machine can't work. So such training expenditure are strictly prohibited to capitalize. Very important aspect which you have to remember. These are few examples, and on the basis of this, you will have to analyze it. So if, let's say, training expenditure is not incurred, what will you, so whether that, let's say, car, I've taken this example in the main batch also. If you have purchased a car, you don't know how to drive it, doesn't mean car cannot work. You take a driver and drive the car, car will be able to be, run as intended. It doesn't mean that if you don't know to drive the car, car cannot be used. It can't happen that way. Alright, and that's why training expenditure is not directly attributable expenditure. That training expenditure is not building that asset to certain level from where I would like to use that asset. That asset is already there. You don't know how to use it. And that's why you cannot capitalize training cost as a part of the machineries. You analyze this way everything, and then you will be able to answer. Correct? Let's say trial run expenditures. Trial run expenditures will help you to bring or enhance the quality of that asset's output. Every time you take the trial expenditure, you check the output of that machinery and you recalibrate that machinery. That trial run expenditure actually make you enhance the quality of that machinery. That can be capitalized. Net of income. When you sell the substandard output, you will get some income, but your expenditure might be higher. So net expenditure is able to be capitalized, directly attributable. Alright. Borrowing cost. Of course, as per IAS 23, all the interest costs which are incurred with respect to the qualifying asset, the asset which necessarily takes substantial period of time to get ready for its intended use or sale, that is a qualifying asset. If you have incurred interest costs or other costs in connection to purchase or construction of a qualifying asset, then borrowing cost is eligible to be capitalized. But for that, certain additional principles of 23 you need to understand. Okay, so there could be specific borrowings, there could be general borrowings. How to capitalize the interest on the qualifying asset from general borrowings and from the specific borrowings. So that you will have to check from 23 separately. but that is a very common question as a part of the PP. So once we'll see the question on PP, you'll find something from 21, effects of changes in foreign exchange rates, and also from 23, borrowing cost. Okay. Now, dismantling and restoration cost. Not applicable for intangible asset. This dismantling and restoration cost, now this is directly attributable. So you're actually capitalizing it because it is directly attributable. Oil rig example which we had taken, that oil rig in a full-fledged batch, that oil rig, once you install, there is a present obligation which you cannot avoid, and that is because of asset installation. So had you not installed the asset, this dismantling and restoration cost would not have been there. Because you have installed the asset, that expenditure is now mandatory, you cannot avoid it. Without that expenditure, asset could not have been installed, and because asset is installed, you have incurred that expenditure, and that's why it is directly attributable. You have to, now this is the present obligation. There is an incurrence, there is event which has already taken place. Now the expenditure you cannot avoid. It's only about the outflow, timing of outflow. That outflow will be there, but in future, when you are not very much certain, but you know at least at the end of useful life. Can you estimate useful life of the asset? Absolutely yes. 10 years, 15 years, 20 years. You estimate. What would be the expenditure that will be incurred? That also can be estimated. And if yes, then you will estimate that. What will be the outflow after certain number of years, that you will have to present value it. That amount you will capitalize it as a part of the asset. Where the credit will go? The credit has to go to provisions. Because if you are not eligible to create the provision as per IAS 37, there will not be corresponding debit. If you are unable to create the credit, the question of debit doesn't arise. Generally, 37 says if you have created the provision, debit will go either to profit and loss account straight away, or it may get capitalized as a part of asset. In this case, the expenditure which I am incurring is with respect to asset which is usable for more than 1 year. That's why related expenditure cannot be expensed out in P&L in 1 year itself. That has to go over the number of years of asset's useful life. Matching concept. And that's why it will get capitalized as a part of that asset. Credit will go to provision. That provision has to be based on IAS 37 provisions, contingent liabilities and contingent assets. And that is how you create this dismantling and restoration. That occurs only in case of a tangible asset. It may be your property, plant and equipment, it may be inventory, it may be also your investment property. It cannot be with respect to intangible assets. These are required to be added or included as a part of cost. There are certain things which you require to reduce it from the cost. What are those two things which are given here? Discounts and rebates, if you are going to receive, if you have received it from the vendor, you cannot include it as a part of cost because that's not your cost, it's your discount. You cannot account it separately in your other income. No, it has to be reduced from your cost because your actual cost is net of discounts and rebates. Alright. Last part is imputed cost of interest in case of a deferred credit arrangement. This deferred credit must be more than 1 year. In order to consider this for reduction as an imputed interest cost, because what happens is if you are giving or providing credit, or you have been provided a credit by a vendor, this actually also applicable from a revenue perspective. The same point which we are going to discuss under IFRS 15 is applicable here. So if vendor is providing you a credit period, let's say, which is more than 1 year, he's actually financing that asset for you. So had you not got that credit period for him from the vendor, you would have borrowed certain funds from somewhere, you would have paid it immediately. and immediate payment would have made you, get the discount, because if you pay the amount immediately today, not after 1 year, then definitely the amount of or the incentive for immediate payment would have been transferred to you. That may be equivalent to the present interest rate, applicable interest rate. But I borrowed it, so I would have paid interest here, but my cost of that property, plant, equipment, investment property, intangible asset or inventory also would have been lower by that extent. This extra payment is not towards the cost of the asset. It is towards the timing difference and for the credit risk of yours, which you are paying it to your vendor. And that time value, that amount, that expenditure is for the time value and credit risk of yours, is not towards the assets cost, and that's why you will have to reduce it, because if it is not specifically mentioned in the purchase contract of that PPE, intangible asset, investment property or inventory, then you will have to calculate that. It is an implicit interest cost. It is interpreted. It is assumed that such interest cost will be there, form the part of the cost, which you will have to reduce it. It is not cost of the asset. It is cost for the time value and credit risk of yours, for which you are paying him separately. Correct? So you have to calculate it, you have to reduce it, and such kind of information will be given. Which rate you will have to use, that rate in examination will be provided to you. Correct? So the principle is given that the vendor and the customer, if they enter into a separate borrowing transaction for such kind of an asset or such kind of an amount, what rate of interest that vendor would have provided to the entity, that rate would be used. Such rate in examination will be given to you. You don't have to think much about it. Or they directly will provide you the amount of interest itself. So that may also happen. So you just have to remember about this, that what could be deducted. So apart from this, nothing could be deducted. Okay. So I hope you are with me on the external acquisition. What could be part of cost when it is externally acquired. Now rest of the things becomes very simple and straightforward, because these things itself will be replicated. Second, if it is self-constructed, instead of purchase price of the asset, you will have purchase price of the raw material, you will have labor cost, you will have direct overheads. So these three things will be there if it is self-constructed. So purchase of material, then labor cost, and then overhead cost. However, in labor and in overheads, ignore indirect overheads and abnormal labor costs. Okay. So any abnormal losses, indirect overheads, you will have to ignore it strictly. Correct? As far as inventory is concerned, there are certain allocated overheads can also be, factory overheads can also be allocated on the inventory, which is not spoken here. As far as tangible fixed assets are concerned, like PP, intangible assets, and other investment property as well, indirect overheads, allocated overheads are strictly prohibited to be capitalized as a part of the cost. You remember this, okay? If there is any such information, you'll have to reduce it from this, okay? And there will be an examination, so you have to be little careful. All directly attributable expenditure, same thing which we have spoken here, is applicable here. Same, exact same discussion. Borrowing cost, same discussion is applicable here. Dismantling and restoration cost, same is applicable here. It is not applicable for the intangible assets. So only thing for self-constructed asset you will have to remember: direct material, direct overheads, and direct labor. Exclude or ignore abnormal losses, which will be provided separately in examination, and ignore indirect overheads, which will be given separately in the examination. So you have to categorically remember about exclusion of this. Deductions, both are applicable, which we had seen here: discount, rebates, and imputed cost of deferred credit. In case of a deferred credit arrangement, that deferred credit arrangement must be more than 1 year. This practical expedient has been provided under IFRS 15 as well. Revenue from contracts with customer. Alright. So there is also, they have provided the examples of costs that are not applicable as a directly attributable. Training cost, cost of opening new facility, cost of conducting business from new territory, administration and general overheads. These are not directly attributable. These are examples given for you, but we have discussed the concept. So on the basis of that concept, you can analyze any type of expenditure. Otherwise, there could be hundreds of such examples which could be provided. And every time there is a new example, you should not always just try and being in the analytical mode. So analyze everything with the help of concept. That's it. Business combination, very simple and straightforward. A cost is equivalent to acquisition date fair value. Absolutely simple. Let's say there is an acquirer who acquires a business and there is an acquiree. Recent transaction I'm telling, let's say there is an ISMT which is an acquiree, and let's say there is KFIL, Kirloskar Ferrous Industries Limited. Both are listed companies. This transaction is also there on the stock exchanges and in the public news. You can read about this. KFIL acquired 51% stake in the ISMT. Correct, for example. So he becomes acquirer and it becomes acquiree. Now the assets of ISMT will be recognized in the consolidated financial statements of KFI. At what rate those will be recognized? Those will be recognized at cost as per the principle of IAS 16. Intangible assets will be recognized at cost as per the IAS 38. Investment property as per IAS 40. Correct, at cost. What is meant by cost? It's not the book value of assets which are recorded in the books of ISMT. Those are the book values of the ISMT or acquiree. He will not sell those assets at book value to KFI. Definitely not. So as on the date of acquisition, let's say whenever the transaction has taken place, the date of acquisition they will determine as a particular date of acquisition. As on that date, whatever is the fair value of those assets, that will be considered as the cost of the assets acquired as a part of business combination. Very simple. Where you will get this fair values, there is an exercise generally acquirer is required to do, purchase price allocation. So whatever the fair value, whatever the assets they will acquire as a part of this business combination, they will do that fair valuation exercise, and then accordingly those fair values will be considered as a cost. This will happen in purchase price allocation exercise, which parent company will undertake this exercise and they will find out this cost. Okay. Important points which you have to consider here is, now you know business combination standard also because we are doing just the revision. So I'm assuming you know business combination to a certain extent. What generally formula we derive to calculate the goodwill? We say purchase consideration X amount at share of NCI, either at proportionate share of fair value of net assets or at fair value of the equity share, less purchase consideration, fair value of net assets, less fair value of net assets. This fair value of net assets is identifiable net assets. This will include certain net assets or certain intangible assets which are not recognized in the books of the acquiree. Let's say acquiree has certain intangible assets like brand, customer list, whatever it is, that might not have been recognized in the books of ISMT because it is internally developed, which recognition of which is not allowed by 38. But then while acquiring the business, KFI must have paid certain amount by way of a purchase consideration for those assets as well. So those are externally purchased. I have paid some amount for that. Now some amount, how it is determined some amount, it is based on the fair value of the asset. I can calculate the fair value of those brands, for example, or those customer lists. if I'm able to calculate the fair value of those assets, then I can say that both criteria are satisfied for the recognition. The asset, if it is acquired externally, it is always assumed that there will be probability of future economic benefits. And if you are paying something out of your own pocket, or if you are able to calculate the fair value of that when it is externally purchased. Now you will say otherwise internally generated intangible asset also I can calculate fair value, but not allowed by the standard. If that asset is externally purchased and you are able to calculate the fair value, then second criteria is also satisfied, the reliable measurement of cost. And in such case, you will identify that intangible asset separately, which is written here separately from goodwill, and the difference between this amount and this amount is recognized either as goodwill or a capital reserve, as the case may be. So point is, for this discussion is, you will have to calculate identifiable assets separately from goodwill, and the assets which are not eligible to be recognized separately from goodwill are subsumed as a part of goodwill. Goodwill is not an intangible asset. Goodwill is an additional cost which is given for certain resources which are not eligible to be identified and recognized separately as asset. Like let's say I have paid certain amount which is for the skilled employees. Now whether employees can be recognized as a part of asset? No, you can't do that. So it will be subsumed as a part of goodwill. Market share. Can you determine market share as a part of a goodwill, as a separate asset, identifiable asset? No, it is not an asset. Market share, I do not have control on market share. Question doesn't arise about recognizing that separately from goodwill. Subsume that as a part of goodwill. Correct? However, brand can be considered identified separately from the goodwill. It cannot be subsumed as a part of goodwill, and that's why you will consider brands, customer list, patents, etc. separately, but then skilled workforce or market share cannot be identified separately as asset. Those will be subsumed as a part of a goodwill itself. Alright, are you with me everyone? So this is the quick discussion on the how to measure assets which are acquired as a part of business combination. Answer is very simple. Acquisition date fair values, which will be given by the valuer as a part of PPE exercise, we will consider that as a cost, as simple as that. Okay. Now, if the asset is exchanged, for one asset I have purchased the other asset. I have given one asset and purchased the other asset. Now the point is, if this is the situation, if I have exchanged the asset and the assets are similar, then there is no commercial substance. Ignore this transaction. Simple. Ignore this transaction. However, if the assets are not similar, dissimilar assets, if risk and rewards changes because of entering into a transaction, then you will have to recognize this transaction. Asset exchange. What would be the cost of income? What we are doing? We are determining cost of the incoming asset. Outgoing asset you have given and you have taken in the new asset. You have given out aircraft, taken in the building, or you have given out building, taken the aircraft. Dissimilar asset. There is a change in risk and rewards because of entering into this transaction. Am I right? Now, because of that, now you will have to recognize this transaction. You will recognize this, but how do you measure this transaction? Initially, at cost. What is cost? Simple. Now, principle is very simple. Just remember about this. Now, whenever we are saying cost, here also, whether it may be external acquisition, it may be self-constructed, in both these cases, how we have determined cost, just because of what you have paid, am I right? Purchase price plus taxes, etc., whatever it is. If somebody is accepting my asset, which is there in my books, and giving me another asset for it, it means that asset which I have has certain value to it, right? But then can I recognize or maintain the same assets carrying value as the incoming assets value? Answer is absolutely no. Why? I will tell you and explain the logic behind this. Think about this. Whenever you purchase the asset externally or you construct the asset on your own, what is the basis for the purchase price you pay? What is the basis for the purchase price you pay from your own pocket? The taxes you pay for the purchase of that asset. It is actually the fair value of that asset in the market which you are ready to pay for that. So the fair value of incoming asset is the basis for you to pay the cost. Am I right? And the same exact principle you have to use it here. The same exact principle you will have to use it here. What is that principle? When you exchange asset, the asset which is incoming asset, you find out the fair value of that asset, and on the basis of that you will record the new asset, measure the new asset, incoming asset. Correct? So that's why it's very simple. Cost of incoming asset is equivalent to the fair value. Now they have given only fair value. I told you the fair value of the incoming asset, from where this is coming. So standard is given the hierarchy. Now let's say fair value of the incoming asset is the first one which is given by the standard. Now let's say you do not have the fair value which is determinable for incoming asset. Then standard has given fair value but of the outgoing asset. Because if somebody is accepting the outgoing asset and giving you the new asset, it means the new asset's fair value is equivalent to the fair value of the outgoing asset. It's equivalent. Correct? So it will be measured, the cost of the incoming asset will be equivalent to the fair value of the outgoing asset, not the carrying value. This is very important because there will be carrying value of the outgoing asset and there will be different fair value of the outgoing asset. If it is determinable more reliably, then you will rely on that. And the difference between that two costs will be the gain on disposal of the outgoing asset. But the cost of incoming asset will be equivalent to the fair value first of the incoming asset. If that's not determinable, then the fair value of the outgoing asset. If both fair values are not determinable, then you continue the carrying value of the outgoing asset. There will be no gain or loss on disposal of the outgoing asset. Your incoming asset will be recognized at the same amount which is the carrying value of the outgoing asset. Only description will be changed, if any. Alright. So this is about the asset exchange. So we had seen external acquisition, we had seen self-constructed, we had seen business combination and asset exchange. All this may be part of your questions. So this is the most important concept of initial measurement, believe me. You have to have mastery on recognition and initial measurement as well as the subsequent measurement. All these topics are extremely important from an exam perspective, not just exam perspective. The same thing will be applicable for your practical life as well. Because we are discussing for the examination right now, we are discussing only for the exam, but this is equally important for your practical life. Okay? Now, subsequent expenditure. Now, this is important for us to understand what is first of all the subsequent expenditure is, and then we will be able to discuss about the accounting treatment of such subsequent expenditure. Now, let's say there is certain time period which lapses in preparing that asset to make it usable. So let's say entities start construction of the asset at this point of time, or they start a process to acquire that asset, install it, commission it, and this is the point of time where asset is ready for its intended use. Now this is the point. Till that time we can capitalize the cost which are incurred as a part of the cost of that asset. which are directly attributable expenditure. We assume that these are directly attributable expenditure and this will form part of the cost of that asset. We will evaluate, and then whatever is there till this point of time, we will actually capitalize it. But once asset is ready for its intended use, then all subsequent expenditure are not directly attributable. That's the conclusion, because directly attributable is those expenditure which are incurred to make the asset usable. Where asset is ready for its intended use, then subsequent expenditure will not be considered as directly attributable, and that's why it is not capitalizable. And that's why subsequent expenditure are classified as generally day-to-day repairs and maintenance costs. Those are charged to P&L as expenditure on an ongoing basis. Correct? Because these are not directly attributable. However, there are certain expenses. Let's say this is a total asset. Total asset is comprised of all small assets or small components which have a different useful life, Aircraft may have a landing gears, may have interiors, may have an engine, may have entire exterior body. All these things may have a different useful life. So these are not the subsequent expenditure of day-to-day repairs and maintenance costs. These are not of this nature. This may not always be. So all or entire subsequent expenditure, wherever entity incurs such expenditure, once the asset is ready for use, it may incur subsequent expenditure at various points of time. Not all the expenditure of this day-to-day repairs and servicing maintenance nature, of that nature. So if it is of a repair and servicing cost or maintenance cost, then you have to transfer it to profit and loss account as expenditure. However, if it is of not that nature, it's not a regular expenditure which is incurred for repairs and maintenance, then you have to evaluate what that expenditure is for, and if that expenditure meets the general recognition criteria, if there is probability of future economic benefits because of that expenditure, where you can reliably measure the cost, then you can capitalize that expenditure as a part of that asset itself. Because this is not general day-to-day repairs and maintenance, these are the costs, these are the expenses which will fetch you future economic benefits. And when the probability occurs and you are able to measure the cost reliably, at that point of time you are eligible to capitalize that as either a separate item or as a part of that asset itself. So where you capitalize it as a separate asset, we call it as a componentization. Let's say there is an aircraft. Landing gears has life of 3 years, where engine has life of 20 years. There is a significant difference between useful life of an engine and a landing gear. Then after 3 years, you cannot use the same landing gear. You will not be able to use the aircraft even if the engine has life of 20 years. So what you will do? You will replace those landing gears with the newer one, which has a life of again 3 years. It's not a day-to-day repair and maintenance cost. It's not usable within that compact 1 year. It's for more than one period. It will allow you to get the future economic benefits. It creates that probability of future economic benefits, because if you do not change, do not replace the landing gears, probably you will not be able to use that aircraft. So if you would like to use that aircraft, you have to replace the landing gears. So cost of replacing the landing gears, so you remove the landing gears, install the new one, but then what you have to do? You will capitalize that, because that landing gear expenses incurred after 3 years will not provide benefit only in the third year, it will provide you the benefit for another 3 years. So expensing out the cost immediately in that year, like repairs and maintenance, it may not be consistent with the matching principle which we have been following since ages. And that's why we will not be able to expense out entire expense on landing gears, because benefit will come for 3 years. So expenditure with respect to that should also be spread over 3 years. So might as well capitalize this amount and depreciate it only for 3 years. We call it as a componentization. You make the componentization. So when you say capitalize it as a separate asset, doesn't mean that you have to showcase in FAR as a separate asset. You will not show that engine of aircraft as one asset, interior as a second asset, landing gears as third asset, and so on and so forth. No. There will be a single asset in the FAR, aircraft. That will be the parent asset. And child asset would be then engine, then your interiors, exterior body, landing gears, etc., which might have a life different than each other. So the depreciation key that will be assigned to each child asset will be different. Depreciation calculation method will be based on the useful life of that asset. That we call it as a componentization of asset. It stems out of this concept of subsequent expenditure and also another concept of componentization from depreciation itself. That concept of depreciation says each significant component of the property, plant and equipment should be depreciated separately, which has a significant different life from each other. If all the parts of value are significant, but then the useful life is similar to each other, then there is no point in depreciating it separately. Because useful life is same, so depreciation will be on the useful life. There will not be any difference even if you depreciate it separately. But if this life is significantly different, like aircraft has 20 years, the engine, and landing gears has 3 years, there is a significant difference in life, useful life. So this landing gears, the cost of landing gears has to be expensed out over 3 years. And this engine should be expensed out over 20 years by way of depreciation. So depreciation key will be 20 years for the engine and 3 years for the landing gears. So that is coming out of the concept of depreciation and as well as the subsequent expenditure. So subsequent expenditure, very simple, I will summarize quickly in 2 sentences. Number 1, subsequent expenditure is generally expensed out if it is in the nature of day-to-day repairs and maintenance. Second sentence, if subsequent expenditure meets the general recognition criteria, then such subsequent expenditure may be eligible to be capitalized either as a part of that asset itself or as a separate asset. Okay, so this you have to remember. There are questions which will be asked on componentization and subsequent expenditure in examination. For example, I will give you an example. We had taught this in our full-fledged batch also. That example I'm going to tell you. Entity constructs a factory. Factory has a useful life of 40 years. However, roof of the factory needs replacement after 20 years. So, replacement cost of the roof is going to occur after 20 years. Subsequent expenditure. Life of factory and factory roof is significantly different. One's life is 40 and another's life is 20 years. You have to depreciate both these assets separately. So it will be one single asset, factory, and in that child 1 asset is a factory building and second child asset would be factory roof. Okay, this is how we'll have to consider the subsequent expenditure. So apart from this expenditure which meets the general recognition criteria, you cannot capitalize anything as a part of that asset. You have to remember this. This is applicable for investment property as well. As far as intangible asset is concerned, intangible asset, it is very difficult to justify whether it meets general recognition criteria or not. It is assumed most of the times that intangible asset, any subsequent expenditure on intangible assets are incurred to maintain that asset's existing performance. And that's why all subsequent expenditure on intangible assets are generally expensed out. Those are not capitalized. But as far as tangible fixed assets are concerned, like PPE and investment property, those may get capitalized if that expenditure meets the general recognition criteria. Alright. So remember this. Our third important point, subsequent measurement. A third important subtopic, I would say, subsequent measurement. So first is recognition, second is initial measurement, and third is a subsequent measurement. Now, subsequent measurement of PP, intangible asset, investment property. We will not see subsequent measurement of inventory as a part of this chapter. Actually, it is very simple. Its cost or NRV, whichever is lower, is the subsequent measurement of the inventory. So there are no complexities about it. So when the NRV is lower than the cost, you have to reduce it. Otherwise, your cost will always be lower. So there is no impairment loss as such on the inventory always, or write down inventory if NRV is higher than the cost. But if NRV is lower than the cost, there will be a write down. There will be a charge to the profit and loss account. This is an exceptional item which requires a disclosure or a separate presentation in the on the statement of financial statement of profit and loss. I'm sorry. So this is about inventory. We are not going to speak separately because this is very simple. Now, subsequent measurement of PP, intangible assets, and investment property. There are three different sections I have done. One is for PP, other is for intangible assets, and third is for the investment property. We will quickly see, and each model we will see separately. What does it mean actually? So now initially on the measurement date, let's say you are capitalizing certain expenditure you have made. You are not charging out immediately to P&L. You are capitalizing here on this date. This is a initial measurement. Initial measurement. Why you are capitalizing this? Why you are considering that expenditure as asset? Because the benefit from that asset is going to get over the number of years. Let's say 1 year, 2 year, 3 year, 4th year, and 5th year. Over the period of, let's say, 5 years, you are going to get the benefit of that asset. So you are going to use it for this 1 year, then 2nd year, 3rd year, 4th year, 5th year. So for the use which you do during the year, the benefit you are getting by the usage of that asset, so equivalent cost must also be debited to P&L. And that's why, so the benefit you are recognizing as income, so cost should be charged to the profit and loss account. That will be in the nature of depreciation. So that you will have to account for it over the period. This is called as a subsequent measurement. Initial measurement, whatever the expenditure you have made to acquire that asset, construct that asset, exchange that asset, or through a business combination, you have capitalized it. Now you have to expense out the related charge for usage benefit to satisfy the matching principle. So it has to be over the period. So how do you measure it subsequently on these dates? Because this asset will be there. How do you measure it? That is important, which we are going to see as a part of the subsequent measurement. Subsequent measurement is different from subsequent expenditure. Subsequent expenditure is expenses which are incurred after the initial measurement date, after the initial recognition date. This is not expenditure. This is just carry forward. You are, let's say, you are not incurring any additional expenditure subsequent to initial measurement, but subsequently you have to measure it. You have to charge some cost to profit and loss account for the usage of that asset. That which are the methods for subsequent measurement that we are going to see. So for first, property, plant and equipment, there are two models which are available. One is a cost model, other is a revaluation model. We are going to see what is cost model, what is revaluation model. Intangible assets are bifurcated into two sections. One is intangible assets with definite useful life, And another is intangible asset with indefinite useful life or goodwill, or intangible asset which is not immediately available for its use. For intangible asset with definite useful life, we'll have similar subsequent measurement model like property, plant and equipment, cost model or a revaluation model. Intangible assets with indefinite useful life or goodwill, or intangible assets which are not available for you, so immediate use, will have only cost model. There will not be any revaluation model available with those assets. Investment property, we have similar models, cost model, but this model is different. We call it as a fair value model, not the revaluation model. So there is a difference between revaluation model and a fair valuation model. We are going to see one by one each model. We have done this, we are just quickly going to revise it, the effects of the subsequent measurement, okay, and each methodology. First of all, PP and intangible asset, there is a policy choice. There is an accounting policy choice, either to use cost model or to use revaluation model. It is up to that entity which method to use. They can choose cost model, but if they choose cost model, they'll have to follow it consistently. If they choose a revaluation model, they'll have to follow it consistently. Now, let's say cost model. If entity is following cost model, then the cost is original cost which we have calculated as a part of initial measurement, that will be considered as a cost. Purchase price, all directly attributable expenditure, non-refundable taxes, etc., etc., etc. Reducing discounts, rebates and included cost of interest. This will be the cost less depreciation or amortization in case of intangible asset, which is based on a useful life of the asset. From that, you will have to test this asset for impairment if there are any indications. This impairment indications are given under IAS 36, impairment of assets. Once we will see this topic, you must have already seen it, but those are internal indicators or external indicators. If there is presence of any indication, then you will have to test this asset either individually or as a part of a cash generating unit for impairment testing. Then if there is impairment, then you will have to provide a loss. Indication of impairment doesn't mean there is existence of impairment. Okay, that has been discussed under 36, not here. So cost less depreciation or amortization based on a useful life or impairment if any, and then resultant amount will be the carrying value. You will find this in your financial statements in SOFP, correct? So you have a gross block or cost block, we call it as a gross block. Then this is accumulated depreciation block. Impairment is a part of that accumulated depreciation block. And last is a net block, we call it as generally. That reconciliation for all the types of asset is required to be presented as a part of disclosures. We may not discuss the disclosures separately and elaborately. Disclosures are not very much important in the examination. So whichever the disclosures are important, I'm going to discuss it while we are discussing the concept itself. So this type of reconciliation of gross block, accumulated depreciation block and the net block is also required in the notes to accounts for each class of asset. Revaluation model for PPE can be followed. So what is actually revalued? This carrying value is revalued. This revalued not on a yearly basis, number 1 point. This is not revalued on a yearly basis. This is revalued on at a regular intervals. Regular intervals doesn't mean quarterly, half yearly, 1 year, 2 years. It's nothing like that. It simply says your carrying value of that plant and machinery or the property, plant and equipment should not be significantly different from its fair value. So you have to compare this carrying value with your fair value. So you have to keep on checking the fair value of the asset. It should not be significantly different than the carrying value. If it's significantly different than the carrying value, then you have to calculate fair value and incorporate that fair value as a revalued item. So your carrying value will be revalued, will be restated to the revalued amount. And then the above gross block and accumulated depreciation block will actually be restated accordingly. So there are two methods. How do you restate this? Alright, we'll see those methods. First of all, I'm explaining only the first point. The first point is you have to revalue the property, plant and equipment at a regular intervals, not yearly, not quarterly, not half yearly. Regular intervals, I've explained the meaning of it. Second, if the amount is revalued, where the gains or losses will be accounted for and how it will be accounted for. So for that we have seen the simple thing. So first of all, we have seen it is an accounting policy choice. For intangible asset, we have not discussed, but that part we will discuss. This policy choice must be applied for the entire class of asset. Then we will come on to how to account for it. Class of asset, let's say plant and machinery is one class. Second class is land and building. Within land and building, there could be administrative building, there could be residential, there could be factory building. This could be two separate classes. Vehicles. Vehicles also you can have two separate classes, factory vehicles and commercial vehicles and passenger vehicles. Then you have office equipments, etc. So this is a class. So not just single asset, this choice is not available for a single asset, but class of asset. If there are 10 items in the class of asset, you'll have to all revalue all those items, not just the one. Revaluation to be taken at a regular intervals. We had done this. We had seen this. It's only with respect to intangible asset we have to see. We'll quickly see that and then we'll see how to account for gains and losses which are resulting out of the revaluation. Intangible assets can be measured under revaluation model if and only if that has an active market. Active market is availability of buyer and seller 24/7. It's the active market. If this is not the case, then you cannot measure intangible assets under revaluation model. So you have to be very careful. Generally, intangible assets are never measured under revaluation model. Okay. So these are the 4 pointers with respect to revaluation model per se. Now we have to see how to account for the gains and losses. The accounting is same for PP and intangible asset, no difference whatsoever. See this. In case I have carrying value as, let's say, 1000, it may be because of 1500 is the cost, accumulated depreciation is, let's say, 500, my carrying value is 1000. It has been revalued to, let's say, 1200, correct? Then this gain is of 200, that is increase of 200. How to account for it? So general rule is this is non-transactional. This is non-transactional. We have seen in the previous topic. And that's why this will be accounted in the revaluation reserve. This is a general rule. And if it's a loss, let's say, if it comes down to 700, then it's a loss. This loss is debited to profit and loss account. Sorry, not this one. I'm sorry, not this one. Decrease is mentioned here. So any decrease will be debited to profit and loss account. Any decrease is debited to profit and loss account. Any increase is a non-transactional, it will be credited to revalue. Gain is income, income is credited, so it credited to revaluation reserve, which is a part of other comprehensive income. However, if there is a loss, standard is little conservative and it is saying that it has to be debited to P&L, simple general rule. What is the exception? If in the previous year, before this gain of 200, if in the previous year any kind of revaluation loss you have accounted in P&L and this time now there is a gain, to the extent of that loss which you have debited to P&L previously, this gain you can credit to P&L to that extent. So let's say previous year you have 100 as a loss, this year you have gain of 200, then 100 will be credited to P&L and balance 100 will be credited to revaluation reserve. So this is an exception. To the extent of any decrease previously debited to P&L, which is 100, such increase can be credited to P&L. So out of this 200 gain, 100 can be credited to P&L. Balance 100 will be credited to OCI. That is revaluation reserve. Okay. Other way around for this decrease now. Exception to accounting for a loss, revaluation loss. Exception says to the extent of any increase which we previously credited to P&L. Let's say out of this there is a gain of previously I had credited revaluation reserve by let's say 500 rupees, correct? To the out of this 700 to the extent of 500 I will debit loss to OCI, revaluation reserve, to wipe off entire balance of OCI. Additional 200 will be debited to then P&L. Additional loss will be debited to P&L. Okay. So to the extent of any increase previously credited to revaluation reserve, such loss will be debited to revaluation reserve. Balance will be debited to P&L. This revaluation reserve which is there, this is a revaluation reserve which is a part of the other comprehensive income. This other comprehensive income, now there will always be a balance of, let's say in this case there will be a balance of 200 in OCI. Now this 200 OCI, what to be done with this? Ideally nothing. However, what we will do is, because of this 200 there will be additional depreciation. Am I right? Correct. Because my carrying value now, new carrying value is 1200 from 1000. So there is 200 extra to be depreciated over the remaining useful life. Correct. Now this 200, it will create an extra depreciation which will be debited to P&L. However, my earlier gain is credited to revaluation reserve OCI, but debit because of this additional 200 will be wiped off over the remaining useful life in P&L by what? Depreciation. So this 200 can be recouped. We had seen this. This has to be recouped either at the end of useful life or over the remaining useful life. To the extent of additional depreciation, let's say my balance useful life is 10 years. So my additional depreciation would be how much? 200 divided by 10, that is 20 each year. So this 20, if I charge debit to depreciation, additional depreciation to P&L, then my credit would be released from revaluation reserve to retained earnings to nullify or neutralize the effect of additional depreciation in P&L. It will be neutralized in equity, not in P&L. You cannot release it to P&L. You cannot release it to P&L. You have to plot the accounting entries. What I'm saying right now, you have to listen it once again if you're not getting it, and then plot the accounting entries. As simple as that. Correct? Rewind it. Go back. Listen to it once again, and then plot the accounting entries. Okay? Now, how to account for this increase? Once this question had been asked in the examination. Which method? Correct? So there are two methods, proportionate restatement method and elimination against gross carrying value. What to restate? Accumulated depreciation block has to be restated or eliminated. Both they are talking about, these methods talk about the accumulated depreciation. So on revaluation, accumulated depreciation or accumulated amortization is to be treated either by one method. Any method which you want to use, you can use it. So for example, proportionate restatement. My cost is 1500 in our example, less accumulated depreciation is 500, carrying value is 1000. This was restated to 1200. So this is 1.2% or 1.2 times. So this will be restated proportionately. So this has increased by 1.2 times. So all amounts will be restated by 1.2 times. Your result will be 1200. So this would be 600 and this would be 1800. Correct? This is 1500 multiplied by 1.2. This multiplied by 1.2. This is already 1 point. Correct? And accordingly, this will be restated. So accounting entry would be cost, my debit, cost of PP by 300, credit, accumulated depreciation by 100, balance credit is for the revaluation reserve 200, which is this. Very simple. So this is first method of accumulated depreciation. Proportionate restatement of accumulated depreciation. What we have to do in the second method? In the second method, we have to eliminate this accumulated depreciation against cost. So first entry would be debit in this case, same example. Debit, accumulated depreciation, 500. Wipe it off, accumulated depreciation as a credit balance. Against what? Against cost of PP, 500. Now your cost of PP is 500. It has been reduced down because of this 500. It became 1000. But what amount I require? 1200. So pass a second entry. Cost of PP, 200. And then equivalent credit will be to revaluation reserve, 200. Correct? Accumulated depreciation set as 0. So in this case, let's say this is 1500. This is cost, accumulated depreciation. This is 1000 is a carrying value. It is revalued to 1200. Set this as 0 because you write it off against this cost, and this becomes 1200 with the second entry. Alright. So this sort of accounting entries will have to pass in the system and then restate the either restate or wipe off against the cost, that accumulated depreciation. Alright. This is how you have to provide accounting in the system. This was once asked in the examination. Once. As far as I remember. I hope you have understood this. There is one small question also. We other two examples, two questions in the full-fledged batch we have covered on this. So these are available in the books. So even if you are not there for the full-fledged batch, that's okay. These two examples are covered in the volume 3 in the topic property, plant and equipment. You will find these two examples and very simple and straightforward. You will be able to solve. Okay. Now, intangible assets with definite useful life we had seen here. It's the same. It's just that what we had discussed, if it has active market, then only we can use it, that method of revaluation. Otherwise, revaluation model will not be able to use for intangible assets. If it has active market. If it doesn't have active market, then only cost model. Intangible assets with indefinite useful life, like brand, let's say patents, let's say copyright, or let's say customer list. I'm not saying these are indefinite useful life these assets have. These assets may not have indefinite useful life. These assets may have infinite useful life, may not have infinite useful life. This may have indefinite useful life. I'm sorry. Indefinite, which means you cannot define. You cannot assign particular number as a life to that intangible asset. It doesn't mean it has an infinite life. No. Infinite is different than indefinite. You cannot define the number for that as a life for that asset. How many years that brand will go on, I don't know. It may be for 10 years, it may be for 50 years, it may be for 200 years. Who knows? But it doesn't mean it is infinite, which you cannot measure. And that's why these assets, it's very difficult to amortize it over some number. Let's say building, we can depreciate it for 40 years, for example. We cannot depreciate or amortize brands in this case because you cannot assign a number. If you cannot assign a number, then how will you provide amortization? Not possible. So amortization is not possible for such indefinite useful life asset. Goodwill. How many years that goodwill will be there? Do you know? No, there is no such life which can be assigned. And that's why goodwill doesn't have a definite useful life. Similarly, intangible asset which is not available for its immediate use. Now, what is the example for that? Very simple, I'll tell you. Let's say this is acquirer and this is acquiree. Acquiree is executing research and development in his books, which is not eligible for capitalization in the books of acquiree. However, acquirer has paid certain amount to acquiree for in-process research and development. Till the time this acquiree has expensed out entire expenditure to the profit and loss account. He has not been eligible to capitalize this. That's okay. But then, while selling the business, acquiree said, this is an in-process research and development, and I think this will be useful to you. So you assess about its usability, its usefulness, and then paying some amount. I'm not going to give it to you at free of cost. So he pays certain amount to him, to the acquiree. Now, considering this is acquired in a business combination, externally, probability of future economic benefits is assumed. Any asset which is acquired externally or in business combination or whatever way, not internally generated, its probability of future economic benefits is assumed to be satisfied in recognition criteria. So there are two recognition criteria. If asset is acquired externally, then probability of future economic benefits is assumed to be satisfied. Then you will, if it is not, then why you will pay out of your own pocket? If you are paying out of your own pocket, you are considered as a rational businessman. You will get certain benefits. So probability is assumed. Second, if fair value can be measured reliably, you can measure the cost reliably. And if you can assign fair value to this, then cost is also measured reliably. Then you have to recognize this separately from goodwill. Both recognition criteria are satisfied, where in earlier situation, in the books of acquiree, this probability criteria was not there, the cost probably was not there, and he did not recognize this, but acquirer will have to recognize this. This is asset which is not yet available for use for the acquirer, because that is in process. And that's why you have recognized it, because it satisfies the criteria, but it is not yet available for its use, immediate use. Such assets will not have revaluation model and will not be we cannot provide any amortization because number of years of useful life cannot be assigned to it, and that's why only one cost model. Instead of amortization, you will have to test this asset annually for impairment, at least annually for the impairment. Very, very important. This is in lieu of amortization, you have to test this asset for impairment. And second level of impairment is whenever there is indication. So first is annual impairment testing, second is indication based impairment testing. Annual impairment testing is in lieu of amortization. Indication based impairment testing is as it is. Correct? Both of these are being mentioned under IAS 36 as well. So IAS 36, you will see the same provision. Correct? So intangible assets with indefinite useful life, goodwill, and intangible assets not available for its immediate use will be tested for impairment twice, one at least annually and second based on indications. This is very, very important. You may get questioned on this. Alright? So think about it. And remember about this. Now, investment property. Investment property has two models. Cost model goes exactly as per the property, plant and equipment. Cost less depreciation less impairment is equivalent to carrying amount. However, one additional disclosure which is required is fair value of such investment property must be disclosed in the notes to accounts. Even if you do not follow the fair value model, the fair value must be disclosed in the notes to account. This is not required for PPE and intangible assets. Okay, so PPE, property, plant and equipment, and intangible assets under cost model does not require you to disclose. It does not require you to disclose the fair value of those assets. However, investment property requires you to disclose the fair value, even if you follow the cost model. Okay, fair value model. Now this is little different. Actually, fair value model will also require you to calculate the fair value, and this revaluation model also requires you to calculate the fair value. This fair value will be as per IFRS 13, and here also the fair value will be as per IFRS 13 fair value measurements. So underlying principles of calculating the fair value is same, but the nomenclature is different. There we call it as a revaluation model for PP intangible assets with definite useful life. Here for investment property it is not a revaluation model, it is a fair valuation model. Well, what is the difference between these two? There are 4 pointers which we need to understand. These are the only 4 pointers. Beyond that there is nothing. Beyond that there is nothing. You need to just revise. I will tell you that if this 30 slides which are there in front of you, these are not even 30 because I have added 1 or 2 pages extra. So there are about 25, 26 because there are transition slides also. If you remove that, there are not more than 24, 25 slides. If you just revise them before examination, your conceptual revision is absolutely complete. Correct? But this is not sufficient. You need to have practice of the past examination question solving. So you have to undergo that. Let's focus on what is fair value model, how it is different from the revaluation model. First of all, fair value model requires you to calculate fair value on each reporting date. They are not said on a regular basis. No. Even if it is quarterly reporting, then you'll have to get the fair value on a quarterly basis. So fair value model requires you or mandates you to calculate the fair value on each reporting day. All differences in fair values of previous year and this year's fair value, gain or loss, both will be debited, credited entirely to P&L. No exception, no general rule, nothing like that. All gains and losses mandatorily will be accounted in the profit and loss account, not to OCI. Nothing will go to OCI. Number 3, if you are following fair value model, because you are fair valuing it on each reporting day with all gains and losses to P&L, you are not required to provide depreciation. Number 4, you are not required to test it for impairment because you are fair valuing that on each reporting day. Unlike in revaluation model, you are doing it on a regular intervals. That regular interval might be after 2 years, 3 years, 4 years also. So there you will have to provide something for a cost, that is depreciation or amortization, which is not required here because each reporting date you have to calculate fair value. So depreciation is not required and impairment testing is also not required. Alright, so these are the points which you must take cognizance of. Last point in this is, if one IP is measured at fair value, all investment properties are measured at fair value. There is no class kind of a concept. Investment property is only single class, that's it. Even if there is land separate and building separate, you cannot separate these classes. If one investment property is measured at fair value, then all the investment properties are measured at fair value. Okay, so quick summary of this is actually given here. Quick summary is given here. PP, you have cost model or revaluation model. Revaluation model and cost model, it depends on which model you would like to select. So all three assets, type of assets, PP, intangible assets, or property, investment property. For all three, there is a choice. Either follow cost model, revaluation model, cost model, revaluation model, cost model, fair value model for investment property. Intangible assets with indefinite useful life, only cost model. That's a summary. Cost model is cost minus depreciation minus accumulated depreciation minus impairment is equal to carrying value, cost model. PP, intangible assets with definite useful life and investment property under cost model, same, exactly same, no change. Revaluation model for PP and intangible assets having active market to it will be measured in this way. Revalued amount minus depreciation or amortization minus impairments is equal to the carrying value. Correct? So you will have to follow this sequence. Even if you are revaluing that, you still have to test it for impairment, those assets. Okay? Revaluation at a regular intervals. Revaluation gains to OCI, revaluation losses to P&L, general rule. Exceptions are there, those exceptions we have seen. Correct? Then about indefinite useful life intangible assets or goodwill or intangible assets not available for use. Single model, there you cannot provide amortization. You have to test impairment twice. One on annual basis, second indication based impairment testing. Mandatory. Investment properties, cost model or fair value model. Cost model exactly like PP. Fair value model, mandatory fair valuation on each reporting date with all gains and losses to P&L. One property fair valued, all properties must be fair valued. Going from cost to fair value is possible. Fair value to cost is not possible. If you are following cost model for investment properties, disclosure of fair value is mandatory. Depreciation and impairment is not required to be provided if you are following fair value model for the investment property. This is quick summary within 1 or 2 minutes, not more than that. Okay, so go through this once again. All right, this application of this will be asked in the examination invariably, either PP intangible assets or investment property. Some or the other question you will get on either of these three topics in an examination, and that's why I'm saying this is the most important topic. And I think we have completed this topic, except barring few now very small discussions. We should be able to complete it within the next 10 to 15 minutes at the max, and then we'll go for the past examination question. Approximately 4 to 5 past examination questions we will discuss. If there is any calculation part, I will solve that, the calculation part only. The explanations, what explanations are required, I will just discuss those explanations. I will not spend time on writing that. Calculation part is important for us to understand. So I will solve it, but I will not write the explanation with respect to that. Okay. So let's do this. Discussion with respect to useful life, depreciation, amortization, and impairment. As I mentioned earlier, depreciation is like a cost which is charged to P&L, which is charged on asset to P&L on a systematic basis based on its usage. Correct? And that's why depreciation method is not a policy choice, it's an estimate. How you are going to utilize that asset over its useful life, that will give us the method of depreciation. So depreciation is charged to P&L on the asset for its normal use, wear and tear, passage of time, etc. or obsolescence. And this is important, we have seen this. Each significant part of PP shall be depreciated separately. From here and that subsequent expenditure, the concept of componentization steps out. Residual value and useful life of an asset shall be reviewed at least at each reporting date. Each financial year end, you'll have to check the residual value. Residual value is what? So let's say your cost of the asset is 1,500, residual value. So after scrapping this, you will receive, let's say, 100. Then this balance amount is depreciable. You will depreciate this, let's say, over the period of 10 years. So this residual value, correct? So residual value and useful life of 10 years is to be reviewed at each reporting date. And along with that, you will also have to review the depreciation method. That depreciation method will be based on the usage pattern. So method of depreciation shall reflect the pattern in which assets' future economic benefits are expected to be consumed, and that's why it becomes estimate. Am I going to use that asset equally for all the 10 years? Or its usage will be reduced over the period, or it will be used at a higher rate initially and subsequently it will be substantially decreased the usage. So based on that, you will have to define the method of depreciation. It's not a policy choice. So change of depreciation is no more a change in policy. It is change in estimate, have to be given effect prospectively and not retrospectively. Depreciation method applied shall be reviewed along with this on each year, on each year end date. So residual life, useful life and depreciation method should be reviewed on each year end date. And the change in depreciation will be accounted as change in estimate and not change in policy. This is very important, especially if you are in India. Then this was different in our earlier standards under Indian GAAP. Now this is different from the Indian GAAP. In Indian GAAP also it has been changed. There is no difference whatsoever between Indian GAAP, Indian version of IFRS and IFRS. Okay. Now it's one and the same. How to decide and define the useful life. This is not going to be asked in the examination, but you just have to consider the expected usage, how you are going to use it, how you are going to maintain that asset, how competitors are going to behave in subsequent period, how technology is going to behave in future, how frequently technology is going to change, advance, and based on that you will have to consider the useful life. You also have to take into consideration the customer's choices, preferences in order to define the useful life of the asset. So may not be asked in the examination, but just you should be aware of. Derecognition. All assets, intangible asset, tangible assets and investment property shall be derecognized, taken out of the balance sheet only when it is actually sold off, disposed of, scrapped or retired from its active use. I'm not using it, it is just a scrap. I will have to take out from the fixed assets or intangible assets or investment property. Just because carrying value is zero, that is total cost minus accumulated depreciation, carrying value zero, doesn't mean you have to derecognize. You will derecognize only upon actual sale or when you retire that asset from its active use. Okay. Again, there is where upon disposal, where the gain or losses should be accounted for, other income. Correct? So it cannot be classified as a revenue. Selling of asset is not your revenue. There is one exception to it, which is given in para 68A, but I don't think which is expected in the examination, which says that dual use property, plant and equipment, para 68A of IAS 16, only property, plant and equipment. This exception is not allowed for the intangible assets and investment property, where dual use property, plant and equipment, if sold, it will be converted from inventory to property, plant and equipment or fixed assets, it will be converted from fixed assets, PP, to inventory, and then sale of that inventory will be considered as revenue. Otherwise, sale of fixed asset or property, plant, equipment, intangible assets, investment property will not be considered as revenue. Net gain or loss will be accounted as other income in the books of accounts. Okay, so you have to be careful. The gain or loss will be accounted on a net basis. When we say revenue, it has to be gross presentation, revenue and related cost. But when we say other income, it has to be net of the expenditure. Revenue is gross, expenses are shown separately from revenue in P&L. But when it's other income, it is net of the expenditure. Okay, so that presentation differs significantly upon disposal. So exception is only available for property, plant and equipment with dual use. Otherwise, PPE also are required to be presented as any gain or loss should be presented net on the statement of profit and loss account. I hope you are with me here. Okay. So by this way, we have came to end of this topic. Disclosures, as I said earlier also, these are not, from an exam perspective, not very important. The important disclosures we have already covered, like investment properties. If investment property is measured at cost, then fair value must be disclosed. Correct? Reconciliation of intangible assets PP must be shown. That is gross block minus accumulated depreciation, impairment, carrying back, net book value or a carrying value. This has to be showcased or presented for previous year and as well as for the current year. So these disclosures I've told. If there is any fair valuation or revaluation we have done, where and how the gains have been accounted for, if there is any recoupment of revaluation, how those have been done. So all that factors are required in disclosures. We are not going to discuss disclosures. This is for your reading purposes. We will not spend time on disclosures. Okay. So we have came to an end of this topic, property, plant and equipment. We will solve the questions on PP, intangible assets, investment property not immediately. We will do investment property and then we will solve questions on investment property. There are some aspects of investment property which require a separate discussion apart from what we discussed here. So at that time, we will be able to solve those questions. So let's solve the questions on PP.